This is Macro Analytics, delivering frank conversations on global macroeconomics and market analysis, outside the mainstream, featuring discussions and debates between Gordon T. Long, publisher and editor of GordonTLong.com, and his guests. The content of this discussion is strictly the opinion of the participants. It is in no way a solicitation for business, nor is it to be considered investment advice of any sort. Always consult a registered investment advisor before making any investment decision. These discussions are extremely hard-hitting and terribly frank, and parental discretion is advised. Now, on to the show.
Good morning. I'm Gord Long with GordonTLong.com, and I have with me John Rubino, well-known author and publisher of the website DollarCollapse.com. Good morning, John. Welcome back to Macro Analytics.
Good morning, Gord. Happy holidays.
Wish you a Merry Christmas and a great season for you. John, I have up your 4 themes for 2014. I wonder if we could step through them and what's your views on what we should expect in 2014.
Sure. Let's start with equity markets, because that's really a fascinating story right now. We've seen stocks in the U.S. and in a lot of other markets around the world go up further and faster than almost anybody predicted. And of course, that's because all the governments of the world are pumping out huge amounts of new currency, and it's finding its way into the hottest assets, which are large cap equities and, to an extent, growth stocks right now. And so the question going forward is, can this continue? You know, are we able to keep pushing equities higher in the year ahead, or do we get a crash like we got in 2000 and 2007? A lot of the technical indicators are back there again. Margin debt, for instance, is where it was in 2000 and right before the tech stock crash, in 2007, right before the housing bust and the stock market crash. And so from that point of view, from the point of view of how much money people have borrowed against their stocks to buy more stocks, we're looking at the end of the road here, and we should see a major correction, which possibly turns into a major or bear market here as all this margin debt blows up and people have to sell stocks against which they had borrowed. And that's one very plausible scenario, that we get a big stock market crash in the year ahead. The other equally plausible scenario is that all the new money that continues to be created by the world's governments continues to flow into the hottest asset class, which is equities right now, at least from the point of view of the average investor. And so people who held off on buying stocks for the last 3 or 4 years because they were worried about what was going on in the world finally capitulate and start throwing all of their money into equities because they can't stand to pass up this easy money anymore. And so we get this huge blow off top in 2014. That's equally possible. That happened in 2000 when during 1999 clearly the NASDAQ and tech stocks in general were overvalued, and yet they doubled again before they finally crashed. So we could be looking at that too. And I wouldn't even hazard a guess about which is going to happen in the next 6 months or 12 months, but each are very possible.
John, I happen to think both are going to happen. All the measurements say we should have a major correction. We're actually overextended more than we were at the dot-com boom in 2000. Having said that, the flows, and I do a lot of work with Richard Duncan on flows of liquidity credit going to debt globally. Until that slows or changes, this will keep going. Our analysis and our work is suggesting we will see, even with the taper announcements, we will still see excess liquidity into June. So we see there's more lift coming here in the markets. However, having said that, then we see a real pullback. And it'll be fairly violent as we really start to see some true deflation setting in. And by deflation, I mean collateral that right now is non-performing and insufficient levels of collateral to support credit. We have a serious collateral problem that will loom. Having said that, that's not the end of the world. We think that the government will step in and start guaranteeing collateral in a big way. We'll start to see then what we always think of as hyperinflation because of that flow. But you're right, the money around the world has been flowing into equities, and we think it's going to maintain itself. And we were talking before the show about Venezuela. You know, their stock market's one of the best stock markets in the world despite all their problems. And the answer is because it's the only place people feel that they can put their money as a store of value. And so equities around the world are becoming exactly that, not for valuations, not for any of the reasons we've chosen in the past, than a perception of safety.
Yes. And that's fairly common in situations where governments are panicking and just pumping out huge amounts of money. Zimbabwe's stock market went through the roof too during their hyperinflation. There are some other fundamental issues that might play a big role in the equity markets in 2014, and one is rising interest rates. It's been kind of a quiet increase lately, but we've seen the yield on 10-year treasuries go back up to nearly 3% again, which is a trouble area for the relationship between stocks and bonds and mortgage rates and housing starts and things like that. So that could be an issue. And then we've also got other countries that are running into trouble that we aren't hearing a lot about, but could be fairly serious. Japan, for instance, requires low interest rates in order to finance a mountain of government debt, and yet they're seeing a trade deficit over the last year that, they used to run huge trade surpluses and that allowed them to finance their internal borrowing, but it's flip-flopped now. Now they're running trade deficits, which means capital is flowing out of the country, which is going to make it harder and harder for them to continue to borrow at very low interest rates, which could cause them to blow up. And the Eurozone, meanwhile, while we seem to be recovering in the U.S., the Eurozone is going in the opposite direction. They're actually regressing. Their economies are slowing down. There are some really shocking stats if you look around at the different countries there. For instance, Spain's unemployment rate is still at depression levels, and its retail sales through September had fallen for 38 straight months. So they're not improving. Things aren't getting better there. And there are some political issues that also we don't have to deal with here. For instance, in France, the anti-Euro National Front is the most popular party. And in the UK, the UK Independence Party, which is also anti-Euro, doesn't want to involve itself with the continent in any serious governmental level way, is becoming one of the most popular parties. So we're going to see some political turmoil there too, at a time when everything is priced for perfection. So there's a lot of political stuff and economic stuff to go with the technical issues in the stock market. So 2014 becomes extremely hard to predict when you throw all of this stuff into the mix.
The EU and Japan, they both frighten me as they do you, John, and I see it as a peripheral problem. And when I say peripheral, I'm not referring to what we used to call the pigs, or Portugal, Greece, Spain, Italy, etc. What I'm seeing is, for example, the euro has been strengthening at such a rate that the peripheral problem now is Central and Eastern Europe, who made loans from the European banks in euro currency. But their economies themselves, where everybody makes their money in their local currencies, because they're not using the euro, they can't make payments. So the defaults that are now looming and growing are really jeopardizing, which I believe are unstable European banks, a significant problem. So these peripherals. Now that's Europe on a strengthening euro. Whereas you got Japan, and the issue there is they're driving the yen right through the floor intentionally and debasing it with a negative, as you point out, with a negative current account. The problem there is peripherals being all of the other Asian tigers who are now at a competitive disadvantage, which are starting to really, truly impact their economies. Now, what do they do to counteract this? Well, it feeds on itself because suddenly they don't have the growth, and their growth is slowing. Never mind, they're slowing from Europe. So these strategies that the EU has put in and Japan to protect themselves are crippling the peripherals.
Yeah, and this is basically the currency war scenario where one country pushes down the value of its currency and is able to buy itself some time by doing that, but then they hurt their trading partners in the process. And then the trading partners become the problem because their economies slow down. They get the economic and political blowback from that, and then they have to respond by pushing down the value of their currency. So it's reasonable to think that Europe is going to have to act aggressively in the next year to push the euro back down.
We've got the four currencies really at a rate of debasement here: the United States dollar, the euro, the Japanese yen, and we didn't mention it, but the sterling, as they print, creating problems in the peripherals, which is a horrendous issue. But the only one who's not in there is China, who now are picking up and buying gold at huge rates.
Yeah, China is a fascinating story for precious metals and maybe for the overall global economy, because they've spent the last couple of years basically buying up all the gold that there is. There is no more available gold out there apparently now than what China is buying, so it doesn't leave much for the rest of the world. There was a fascinating interview that was posted a while back with a guy named, let's see, what was his name? Alex Stanzik, who is a chief market strategist for a group of companies called Anglo Far East. And he went to Switzerland and met with some of the big gold refiners there. And they all told him that there is literally no more gold. China is taking it all. They're digging as far back into their vaults as they can go and taking gold bars that have been there for 20 years, and they're melting them down and refining them into the size of bar that China likes and shipping it to Hong Kong and Shanghai. And so the question is, what is China's strategy here? Are they buying an asset that they expect to go up in value? Or are they making an investment? Or are they pursuing a monetary strategy that involves, at some point, them backing their currency with gold explicitly and creating the world's new reserve currency, or something in between those two strategies? And however you slice it, it's a smart move on China's part, because at a minimum, they're accumulating something that the West has basically given away at fire sale prices. And at the other extreme, they're turning themselves into what the U.S. used to be, the owner of the world's reserve currency, with all the benefits that accrue to that. That's why we've got a global military empire, because everybody in the world wants dollars. Well, take that away and create a world in which everybody wants yuan instead of dollars, and then the geopolitical calculus is flipped on its head too. So that's a fascinating story that, at a minimum, is interesting for precious metals investors and might have an impact that goes way beyond just the precious metals markets.
Something's going to happen in 2014 in gold, because the marginal cost of production right now is between $1,250 and $1,300. And the cash marginal cost is $1,125, and we got gold trading at, let's say, $1,200. The miners can't stay in business. So we've manipulated, or I use that word maybe incorrectly, but somehow there's a disconnect between the physical and the paper we've known about for quite some time. China can't buy it fast enough for whatever reason, but it can't keep going on because, I just saw this interview with Bloomberg's Ken Goldman and talking about in London, there's literally no gold in the gold vaults when you go there. It's gone. And the Chinese, as he said, the Chinese don't want U.S. dollars anymore. They want gold. And that's from somebody, if you want to go and listen to the video, that's how they make their living, looking at it.
Yeah.
And then I see J.P. Morgan, who were selling, now they can't seem to buy it fast enough.
Yeah.
Just recently here in the last, I would say 2 months, 60 days. And John, for what it's worth, our gold charts, we've been saying there's been another down, and I have it up here now, the charts, where we thought it was going all the way through this year. These are no new charts, but you can see we're now approaching where we thought the bottom would be and the pivot would be, and which is suggesting that in Q1, Q2, that we finally start some fairly major moves up. At least that's what our charts have been telling us for 2 years now.
Well, gold's price has fallen below the cost of production twice in recent memories, once in the late 90s and once in 2008. And in both cases, that was the launch pad for a major bull market after that, because you get the miners closing down mines and scaling back the development of new mines. And so at the margin, the supply starts to shrink. And to the extent that matters in the gold market, that's not a huge factor, but it's enough at the margin to at least create a bottom. And so we'll probably see that again.
We've taken the luster off it, with gold being down 28% this year, and it being the first year in years that it's been a losing proposition. So it's chased a little bit of the speculation out of the market. That's usually your sign that it's here. Your last one was velocity of money.
That is a very interesting concept going forward, because basically what's happened in the last few years is the Federal Reserve has given the big banks huge amounts of new money, and in the hope that those banks would lend it out and get the economy growing again. But instead, the banks just redeposited that money with the Fed and collected a very small but guaranteed interest rate from it. Now, for the big banks to continue to sit on that money, they've got to pass up what looks like easy profits out there all of a sudden. You know, the housing market is recovering and stocks are going up and businesses are willing to borrow again. And so it's not the nature of bankers to pass up easy money. And so for them to turn around and start lending that money out again, which you would expect them to do as the economy starts to grow, you get the possibility of the fractional reserve banking system taking those reserves and multiplying them in the economy. And so we get this huge amount of new money flowing into the economy all of a sudden. And changing everything, because we're talking several $1 trillion at a minimum of new loans hitting the market if the banks start lending again. And we would see that in the velocity of money, which is a measure of how often a given dollar in the system is turned over, how often it's spent. And so if we see that start to spike, then we may be entering something like the Austrian economics crack-up boom, or at least a rapid acceleration of economic growth, which would completely change everything at this point. You know, we got stocks at record levels and real estate prices coming back, and the price of a lot of other hard assets going through the roof already. So add to that a rapid increase in lending out there, especially in the private sector, where businesses and individuals are already starting to borrow more money than they have in the last few years. And you get the potential for either dramatic growth, which seems good at the time but leads to instability in the future, or instability in the short run when all this money just hits the system and sends asset prices through the roof, and we get even more extreme bubbles than we've had in the last few years. So this is another wild card. There are just so many of them out there where you can't really predict what is going to happen, because either scenario, the slowdown scenario or the speed up scenario, are both equally plausible. And so I think that's something that we need to watch. We need to watch the borrowing levels in the private sector, which the Fed just reported have begun to accelerate. And we need to watch excess reserves in the banking system to see if they start to decline because banks are lending out money. And so either one of those are very important for the stock market and for the general economy going forward.
I absolutely agree with you. I think that the $2 trillion that is sitting at the excess reserves, the Fed has been hoping the wealth effect would kick in, that the consumers and commercial will start to lend in a bigger way. But I think they're sitting here now knowing that that's just not going to happen at the rate that they thought it was going to happen. And so sometime in 2014, these excess reserves, and I said earlier about collateral being a problem. There's just a serious collateral problem to support credit growth. And one of the ways you can fix that if you're the Federal Reserve is to guarantee collateral. And so new forms of guarantees, whether it's student loans or whatever. And if you start to do that, the banks will lend that money and they will push it out immediately, because what they want is they want it secured. And if they can get a government guarantee on the collateral that's being secured, it'll be moved at very good rates. But as you correctly point out, they're making, maybe it sounds like a marginal amount of money now to sit there, 0.25% on those reserves. But we need to put it into perspective. We're talking about 0.25% on $2 trillion. I looked at it this way. It used to be that the banks in group before 2008 made about $200 billion in revenues from interest on money that was lent out. But they would pay out about $100 billion thereabouts for people, savers, depositors, retired people on that interest, so that they would pocket $100 billion. Well, what's happened is, since we went into financial repression, we've driven it down that their interest rates, and I'm not talking about excess reserves, are only about $100 billion. But meanwhile, they only pay out about $13 billion. So there's $100 billion. So the banks have not lost with financial repression. Their bottom line is still the same. It's just all the savers have lost. But where they're making their money is sitting over on these excess reserves, which is accounted for differently. So, 0.25 of $2 trillion is a lot of money.
Yeah, and their risk-adjusted return
exactly
is probably better from their point of view, because they took no risks to do this. This was absolutely free money for them.
And also, don't forget for a moment, they're still lending it out as collateral themselves. They can still use that as collaterals under the repos, and so how they structure it. So this stuff just gets leveraged right out. So they're they're doing all right from it. Where it's really hurting, as I said earlier, are the pensions and the insurance companies who just don't have the same viability. John, we're up against our hard line. Time always goes by so quickly. Any kind of closing comments here to summarize these trends for 2014?
Yeah, I think we're looking at a fascinating year, Gord, and one that is inherently pretty unpredictable right now. But it'll coalesce one way or another by the end of 2014. And we'll look back on this year as a very, very important one, I think, because a lot of things that are going to happen in the year ahead are going to determine what happens for the next decade.
Yeah, John, I think actually all your trends kind of integrate together here, because they're really the fact of excess liquidity and liquidity being the solution and things starting to break or adjustments starting to come to closure because we've been doing it for an extensive period of time. We've been doing this for 5 years, and it's accelerating when we look at Abenomics. So you can only go on before things start to fracture or crack or major changes have to be made. So we can expect those in 2014, and hopefully they'll be positive ones.
Hopefully, yeah.
All the best to your investments in 2014, and thank you very much.
Thanks, Gord.
Talk to you later. Bye.
This has been Gordon T. Long, editor and publisher of GordonTLong.com. New recordings are posted regularly and can be found at GordonTLong.com. New show notifications are available through RSS feed, iTunes, and other social networking venues at GordonTLong.com.